Mortgage rates are climbing and demand is slumping, but will this be enough to cool our housing market? This week on Market Watch. What's up, everybody? Welcome to this week's episode of Market Watch. I'm Jason Zwolak of the Zwolak Group with First Team and Christie's International Real Estate. I hope you all are having a great week. For those of you tuning in for the first time, each week I tackle different real estate topics, including local market updates, all in the hopes of helping you navigate the world of home buying, selling, and investing. If you like this video, make sure you hit that thumbs up button and don't forget to subscribe so you're notified every time I post. I post new videos every week. Following the best year for local real estate since 2005, currently the Orange County housing market is in a slump right in the middle of our spring market. According to Mortgage News Daily, 30-year mortgage rates have risen from 3.27% on December 31st to 5.55% today. These rapidly rising rates have caused buyers' affordability or buying power to significantly drop. For example, the monthly mortgage payment for a $1.1 million purchase with 10% down has risen from $4,319 on December 31st, when rates were at 3.27%, to $5,652 per month today at 5.55%. That is a $1,333 per month rise, or almost $16,000 per year. And to think, this change occurred in only 4 months. California Association of Realtors reported that the median detached home in Orange County rose to $1.3 million in March, up 27% from last year's levels. At these levels, rising mortgage rates significantly impact payments. In response to these rising rates, demand has slowed considerably. Demand has been on the decline after peaking on March 31st, dropping 6% then. Usually demand peaks from the end of April to the end of May. This year, with rising interest rates, many buyers backed off purchasing. The peak occurred early, and not everything is selling instantly. Today's demand readings are down 30% compared to last year. However, we do have to remember that last year was the best year for Orange County housing since 2005. Yet today's demand is down 23% compared to the 3-year average prior to COVID, which is 2017 to 2019. Demand has definitely stalled this spring. During the spring market, demand normally is on the rise along with the active listing inventory. More homes come on the market during the spring than any other time of the year. There is more escrow activity because families want to open escrow in hopes of closing and moving at the end of spring or during the summer when the kids are out of school. The housing market revolves around families and the school year. Spring is when there is the most activity, followed by summer. Then housing decelerates during the fall after the kids go back to school. It then downshifts even further during the holidays, which are the slowest time of the year. This year has been a bit different. Housing activity is down. Low mortgage rates fueled the explosion in demand in 2021 and 2020. Today's considerably higher mortgage rates has cooled demand. As a result, the active inventory has grown by 36% in the past month alone, and the expected market time has risen from 20 to 29 days. The market is still an insanely hot seller's market, and the inventory is at unprecedented low levels, but the market is currently evolving fast. The market will continue to cool, demand will drop, the inventory will surge higher, and the expected market time will rise. Housing is moving away from everything selling in an instant. Instead, sellers will need to price their homes in line with the current market to have success. The housing inventory will grow on the backs of homes that do not sell. Homes in inferior locations, like backing to a busy street, need to be priced accordingly. Homes that are in poor condition and need a lot of work must adjust their prices appropriately. Sellers who overprice their homes will sit on the market until they adjust to their fair market value. Housing simply will no longer absorb overpriced homes or homes in poor condition or a poor location. Demand is slumping. Along with this slumping demand comes a shift in the way buyers and sellers will approach the market to achieve their real estate goals. Over the past couple weeks, the active listing inventory in Orange County surged higher, up 21%, and now sits at 2,104 homes, climbing above the 2,000 home threshold for the first time since last October. This was the largest two-week rise since April of 2018. Although this is good news for buyers, it is still its lowest level for this time of year since tracking began in 2004. It is lower than last year at this time, but that should change within the next couple of weeks. With demand cooling due to the higher mortgage rates, the inventory can advance higher at a more rapid rate. This should continue throughout the spring and summer markets, which is when more homes are placed on the market than any other time of the year. Last year, the inventory was 8% higher than the current levels. The year-over-year difference has been continuously growing smaller since the end of January. The 3-year average prior to COVID is more than double what it is today. There were a lot more choices back then, though this is slowly changing as well. As I mentioned earlier, demand is on the decline and is down 3% over the past couple of weeks. Last year at this time, demand was 43% higher than it is today. In the past couple of weeks, the luxury inventory of homes priced above $2 million increased by 19%, reaching its highest level since September. The inventory has increased by 61% since the beginning of the year. Luxury demand dropped by 16% over the past couple of weeks and now sits at its lowest level since the end of January. With the supply surging and demand plunging, the overall expected market time for luxury homes over $2 million increased from 56 to 80 days. This is still an extremely hot market for luxury, but it's no longer instantaneous. At 80 days, it is considered a slight seller's market. Year over year, luxury demand is down 28%, and the active luxury listing inventory is down 13%. The expected market time last year was at 66 days, stronger than today. This is the first time that expected market time is higher than the prior year, dating back to May of 2020. For homes priced between $2 and $4 million, the expected market time in the past 2 weeks increased from 40 to 61 days. For homes priced between $4 and $8 million, expected market time increased from 84 to 107 days. And for homes priced above $8 million, the expected market time increased from 157 to 201 days. At 201 days, a seller would be looking at placing their home in escrow around November of this year. Although the market is definitely cooling, it is still very strong. However, the days of sellers asking any price for their home are gone. Sellers need to align their home properly in today's market. Above everything else, it needs to be priced accordingly and marketed to everyone. The buyers that are still in the market can find success as they will have more choices and there may not be as much competition. There are wins to be had on both sides. You just need to have a strategy and a plan to have success. If you like this video, make sure you give it a thumbs up and don't forget to subscribe so you're notified every time I post. If you have any questions, send them to me directly or write them down in the comments. I'll make sure to get to them as I'm here to help in any way that I can. I hope you all have a great rest of your week, and until next time, take care everybody.